Good afternoon, everyone, and welcome back. I know many of you are still partaking in that power lunch, and hopefully the hall will get filled up quickly. Mr. Chidambaram, unfortunately, he's always been on time since I've known him, and he has to leave because there are matters of state that he has to attend to very urgently. So he's requested that we begin bang on, and that's what we're doing. I know after that heavy lunch, many of you all might think of taking a power nap of sorts. But just forget it, because our next speaker, given his formidable reputation, will not only keep you wide awake, but will certainly give the Modi government a wake-up call. Ladies and gentlemen, please join me in welcoming our distinguished speaker, Mr. P Chidambaram, with a round of applause. I know Mr. Chidambaram really requires no introduction, especially to such an informed audience. But for a short one, his academic record is impeccable. Mr. Chidambaram has studied law, statistics, and has done an MBA from Harvard University. He has been union minister many times over, notably of finance and home. His understanding of government, finances, and law is formidable, and several of the budgets he presented were considered among the most path-breaking. He led India's finances through some of the critical periods, particularly during, if you recall, the 1997-98 Asian financial crisis and the economic downturn after 2008. During that period, he was responsible for several landmark reforms. He was also entrusted to lead the Union Home Ministry after the country was going through a very tough time. If you recall, it was the 2008 Mumbai attacks, and many of you all would have witnessed the horror that happened in Mumbai while you were there. And I had the pleasure of interacting with Mr. Chidambaram during that particular time, and of course later as well. But I recall that he was really a reluctant home minister. He would have preferred to be in finance. But I must say, he handled the home portfolio with aplomb. He brought several far-reaching reforms in the national security setup, and most importantly, he just didn't announce them. I know he had a slate where he used to tick off every day, and he pushed his officials to implement those reforms. My business colleagues here, Prasenjit and others, tell me that they never dare to go to Mr. Chidambaram's press conference or to meet him without thorough preparation. He pounces on a weakness of an argument and can spot an error a mile away. Today, of course, Mr. Chidambaram is not in government, but that does not make him any less relevant and critical to India's governing framework or to the Supreme Court where he practices law. He continues to make his views known frankly through his columns and speeches and interviews. Ladies and gentlemen, it is indeed an honor for us to have Mr. Chidambaram deliver the definitive State of the Economy address at the Business Today Mind Rush. Yesterday evening, as you know, we all listened to Mr. Jayant Sinha, Minister of State for Finance, and he defended the government's performance. This afternoon, sir, we look forward to you to give us a reality check. May I now request Mr. Chidambaram to deliver his keynote address on the state of the Indian economy. Mr. Chidambaram, please. Thank you.
Mr. Raj Changappa, distinguished guests, it could not be a coincidence that I have been asked to speak on the definite state of the economy on a day when the annual mid-year review was put in the public domain. I had written the text of my speech substantially yesterday, but this morning I was sorely tempted to throw it away and simply read to you the mid-year survey. But since I have a text and I have to be faithful to what I wanted to say, let me make my speech, but kindly keep in mind, I did not write that mid-year survey. As the year draws to a close, it is appropriate to take stock of the state of the economy. There are many business persons among you, and you will draw your conclusions based on how your businesses and the businesses of others fared. There are many analysts among you, and you will draw your conclusions based on application of the ratios and metrics which are the tools of your trade. I would like to review the economy from the point of view of a reasonably well-informed citizen and ask some common sense questions. Let's begin with growth. In the quarter July-September, that is Q2, India's GDP growth was 7.4%. Is that good or bad or mixed? That depends on what you compare it with. It is bad if you compare with the corresponding quarter last year, when growth was 8.4%. It is mixed if you compare with the previous quarter, when the growth was 7%. And it is good if you compare with something vague like expectations. Some would argue 7.4% is not too bad. We are not in a crisis. Things are getting better. They may also argue government is doing all it can to take India to 8 to 10% growth rate. I want to push back against this complacent view. Between the first half of 2014-15 and the first half of 2015-16, growth decelerated from 7.6% to 7.2%. For the whole year, government's economic survey had predicted 8 to 8.5% growth, and the government's budget had assumed 8.5% growth. RBI's projection for the full year is now 7.4% with a mild downward bias. It is obvious that the government is trying to temper expectations down to about 7.3%, so that at the end of the year, they can say, we did better than expectations. I'm afraid 7.3% GDP growth is not good. Certainly not good enough for India. We have done better, we can do better, but the government is muddling along. Let us delve a little deeper into these GDP growth numbers. 3 issues should worry us. First, what is the source of this growth? Second, the possibility that we may be overstating growth. Third, about the consequences of unusually low nominal growth. Where is the growth coming from? As for the composition of growth suggests, most of it is on account of benign commodity prices and increased capital expenditure by government. There is hardly any investments in the private sector. This year, the government delayed the fiscal consolidation roadmap to allow itself an additional borrowing of 0.3% in order to increase public spending. There is no evidence that the increase in public spending has crowded in private investment. I also think that we are probably overstating growth. For the first time in memory, the GDP deflator used to derive real GDP growth from nominal growth is negative at about minus 1.4%. This is because of the historic decline in global commodity prices, which has pushed wholesale price inflation into negative territory. In the Monetary Policy Report published in September 29, RBI raised serious issues with the way deflators are being used. It seemed to suggest that the deflator is lower than it should be, and therefore GDP growth is being overstated. Nominal GDP growth is now admitted to be 6%, one of the lowest in recent years. Since the deflation is negative, another rare occurrence, 6% nominal growth translates into real growth of 7.4%. Nominal growth of 6% is a cause of worry. To find a lower nominal GDP growth, we have to go back 50 years. It was in 1965-66. Nominal growth was less than what it was in Q2 of this year. There are certain implications of such low nominal growth. If nominal growth continues to be low, there will be consequences. Government debt as a percentage of GDP would increase fast, and this will make debt all the more difficult to service. Government borrows at about 8%, and if nominal growth is less than that, the interest burden of the government will increase. Also, because the denominator is lower than estimated, the fiscal deficit as a percentage of GDP will be larger, and in order to meet the fiscal deficit target, government would have to slash expenditure even more or raise more revenues. The problem affects your firms as well. There is already high financial stress. For about a quarter of non-financial firms, operating profit in Q2 was less than the interest expenses. If growth is lower than the interest rate paid by the firms, this stress will only get worse. My conclusion is that there is nothing to be happy about the 7.4% growth in Q2, which actually hides the nominal growth of 6% and is caused by a negative deflator. Let me now turn to the other economic indicators, beginning with the main driver of growth, investment. It is generally accepted that private investments are not picking up, and there are few signs that they will pick up in the near future. The second quarter witnessed a decline in private projects announced and those under implementation. Total proposed investments in the first 8 months of 2015 were about 30% lower than in the same period a year ago. Compared to last year, the pace at which private projects are getting stalled is almost the same, while the pace of revival of stalled projects has declined sharply. To make investments, firms need earnings. In the June-September quarter, that is Q2, net sales of firms fell by 5.3% compared to the same period a year ago, making it the third successive quarter of shrinking sales. This is a first in recent memory. The manufacturing sector looks particularly bleak, with net sales down 12%. Firms can also finance investments through borrowings. As per the statement published by the RBI on December 10, credit growth is at the slowest in 20 years. Non-food credit growth is at 8.3%. Credit to industry is growing at only 4.6%. Credit to medium enterprises actually shrunk by 9.1%. You are best placed to tell us if you think your firms will make more investments in 2016, given lower earnings and an obvious unwillingness to borrow. Let us now look at production and exports. India's economy needs manufacturing to pick up. And we must manufacture goods both for domestic consumption and for exports. Domestic consumption is important because that alone will provide sufficient demand for goods. Exports are important because we need to earn the foreign exchange to finance our imports. At 9.8%, growth in the index of industrial production in October, up from 3.8% in September, looks impressive. But as many economists, including the government's chief economic advisor, were quick to point out, this high growth in October was mainly due to the base effect. Last year, both Diwali and Dussehra fell in October, and as such, there were fewer number of working days during the month, leading to a contraction of 2.7% year-on-year. Adjusting for this base effect, the trend growth in industrial production remains in the range of 2.5 to 5%. Domestic demand, therefore, does not appear to be picking up. I suspect it is because of the distress in rural India and the decline in rural consumption. Farm sector experts have warned government about the growing stress in the agricultural sector. Poor competitiveness of the economy is showing up in export numbers. Exports declined by 24.4% in November, making that the 12th consecutive month of exports shrinking year on year. We have never had such a period before. And this is not because of petroleum products. Non-petroleum exports declined by 18% in November. Many categories of manufactured goods have witnessed sharp decline. Global slowdown is indeed a cause, but the pace of decline, say in China's exports, is only 1/3 of that in India's exports. Receipts from services exports fell by 1.9% in September and rose by a minuscule 0.2% in October as compared to the same month last year. Services exports have been stagnant for a while now. We have never had such a long stretch of poor export performance since 1991-92. Nobody in government is willing to talk about it. And nobody in government seems to know what to do except blame the global situation. Let me now say a few words about what concerns most ordinary people and most families. It is jobs. Wherever you go, the question is, where are the jobs? Please tell me, how many new jobs were created by your firms in 2015? How many people do you know who have created employment for themselves, who we call the self-employed, through starting a new business? The 26th Quarterly Employment Survey, conducted between April and June 2015, shows that job creation in the manufacturing and export-oriented sectors fell by a net 43,000 jobs from the previous quarter. This is the worst performance in 6 years. In the same quarter of 2014, these sectors had added 182,000 jobs. In spite of all this, the government was painting a rosy picture, at least until this morning, citing data on inflation, indirect tax collections, balance of payment, fiscal position, FDI. Let us examine these claims. For more than a year, CPI inflation has been below 6%. Retail inflation was 5.4% in November. A steady decline in inflation began in November 2013, well before the new government took charge. RBI's monetary policy mounted an attack on inflation. Commodity prices, including oil, crashed because of external factors. In all this, government's role was more or less absent. For example, government did little to contain food prices. As a result, food prices inflation today is still about 6.1%. The finance minister cited the 36% increase in indirect tax collection as evidence of economic revival. Most of this increase is due to increased tax rates. Net of the additional tax measures, indirect tax collections are up only 11.6%, which is normal. The current account deficit is low at 1.2%, but that is because petroleum and gold prices are at historic lows. If those prices had remained where they were 2 years ago, CAD would have been more than 3%. Low oil prices have also given a fiscal bonanza to government, a lower energy subsidy bill, and higher excise duty collection from petroleum. The most recent increase was only 4 days ago, and the government expects to collect another 2,500 crore in the remaining 3 months. The government is celebrating increase in FDI from US $36 billion in 2013-14 to US $44 billion in 2014-15, and an 18% increase in April-September this year over the corresponding period of last year. I must point out that FDI was US $42 billion back in 2008-9 and US $46.5 billion in 2011-12. The last major jump in FDI occurred between 2005 and 2007, when it quadrupled from about US $9 billion to US $35 billion. Since then, FDI has been pretty much range-bound, US $35 to $45 billion. There is therefore nothing in the latest data that suggests a notable upward trend. I would be happy if government statements were intended to reassure the people while the government is working quietly to solve the problems. That, however, does not seem to be the case. Except for a few bright spots, there is no evidence that the government has an overarching vision or strategic goals or definite milestones, or a definite work plan to move the economy steadily forward. If there is one theme that defines the governance approach of the government, it is this. There's a lot of activity, but little action. When the government acts, it does so without a strategy. Every now and then, a new scheme or project is announced without following up with sound implementation. Swachh Bharat, for example, was announced with so much fanfare, but the number of toilets constructed every year under Swachh Bharat is lower than that during the UPA years. Similar stories can be told of other schemes launched by the government. I think it is time to get serious about governance. With about 13 million youth entering the labor market every year, we need to create more than 1 million jobs a month. In India, to get growth with job creation, the government must have a two-pronged strategy: investments in human capital and reforms of markets. Investing in human capital means investing in health, education, nutrition, and sanitation. Reforms of markets include reforms of markets for products, agriculture, industry, and services, and markets for factors, land, labor, capital, entrepreneurship. These agendas cannot be fulfilled without improving the administrative capacity of the government. My advice to the government and to those of you who can influence the government is to first acknowledge that the government of India is a continuing entity. There is no such thing as my government or your government. It is our government. Every government must build upon what was done by the previous government. The UPA government gave India its best decadal performance since independence. The 10-year GDP growth was the best ever, at 7.5% under the old series and 7.7% under the new series. Every crisis, 2008 and 2012, was faced with courage and sound policies. A good recovery was underway when we demitted office. GDP growth had jumped from 5.1% in 2012-13 to 6.9% in 2013-14. A recent research paper showed that the best performance on job creation in the manufacturing sector was between 2003-4 and 2011-12, when job creation rose 7% annually, which is much higher than the job growth in previous periods of high growth. At the moment, there seems little appetite in the government to acknowledge that there was anything good about earlier governance models. That is unfortunate. But what is worse is the deep cuts in the budgetary allocations for agriculture, drinking water, education, and nutrition programs. The cuts seem to suggest that these are not priorities for the government. This must be reversed. India still has millions of low-income households who do not have the resources to invest in their children's human capital. The government cannot turn its back to them. If we do not make these investments, we will discover that even if we are able to create the jobs, we will not have a skilled and healthy labor force to make the requirements of those jobs. On the economic front, the government should first finish the UPA's unfinished agenda. The GST is an imperative reform, but the bill before Parliament is deeply flawed. If the suggestions to amend the bill, at least on 3 crucial points, are accepted, the bill can be passed. The government also seems to have abandoned the Direct Taxes Code and implicitly abandoned the recommendations of the Financial Sector Legislative Reforms Commission. These are serious mistakes. These ideas came out of years of deliberation and careful analysis and should be taken forward to the logical conclusion of new laws and a new regulatory framework. Let me conclude on a note of optimism. Among the young people of India, who make up nearly 65% of the population, there is hope, aspiration, and energy. Among business persons, there is innovation, creativity, and the spirit of risk-taking. Among professionals, there is a competitive spirit and a desire to be the best among the world. In many institutions, there are reformers and institution builders. All these positives can be harnessed if the political leadership of the country makes a sincere and determined effort to build a consensus, reach out to all sections of the polity and the society, focuses its energies entirely on development and reform, and instill the belief that the government has at heart the welfare of all the people of India. In recent months and in recent weeks, we have seen too many acts of, what shall I say, for want of a better word, too many acts of foolishness. Maybe the acts were unintended, but once you do something, the consequences must be foreseen, and therefore they are intended. There is still time to pause, reflect, make a course correction, and press forward. The mid-year analysis is a good starting point. Thank you.
Thank you very much, Mr. Chidambaram. We asked for a reality check and you gave it to us. Yesterday, Mr. Sinha talked of beauty being in the eyes of the beholder. In his eyes, the Indian economy was truly beautiful. In yours, it looks ugly, and we need to do a lot of it. But thank you very much for this. And just a small...
He did end the note on a positive note there. Mr. Chidambaram, thank you so much for joining us. A small token of appreciation, please, if you could just kindly accept it on behalf of all of us. Well, there are many questions.
Unfortunately, Mr. Chidambaram told us that he had to rush off because of the current crisis happening. And so he apologizes for this. Do you have time for a couple of? Not at all. I'm sorry. Thank you very much. Thank you.
Thank you, sir. Thank you so much once again.